And there was a big black hole in the tourism sector. We raised $1 million USD. We've built 3 wonderful startups. We have 3 other ones that we're building right now. Like in our 3 businesses have been very different. So, we've gone from one has $100,000 of revenue a month. One has $4,000 of revenue a month. Where those 2 businesses intersect, magic can happen. So our model is a relatively late stage venture studio. So we are funding the business until we get a co-founder in place. We bring in a co-founder to run the business, give them a significant piece of equity, and then continue to support them as they grow and scale. We're not looking for a 22-year-old kid who's bright, straight out of school with good ideas. Geographic diversity is quite important in the African market. Our salaries shortly a few $100s a month to $8,000 or $10,000 a month.
Hi, my name is Max Pock. I am an entrepreneur and I record interviews with startup studio founders. Today my guest is Ben Peterson, a founder of Purple Elephant Ventures, a venture studio based in Nairobi, Kenya. They create tourism startups. What I love about Ben's story is, first, he has a previous experience in venture capital. Second, he has a previous experience in creating a media company and it helped him to acquire one African company, transform it, media company, for nomads. Third, Ben has more than 15 years of connections and love to Africa. He understands this market. Fourth, they're industry specific. They create travel and tourism startups. Fifth, you can create very lean startups because living expenses in Africa are low and salaries are lower than those in Europe and North America. And at the same time, your customers are people from Europe and from North America, tourists. And the last thing, the startup valuations are pretty the same as in Europe and North America. We can just get to know each other.
Great.
So,
and just to begin, Max, I loved that report you did. I thought it was super cool. So well done, sir. Like that was.
We'll put it in the interview.
Yeah, that was one of the best reports I've ever seen on venture studios. Very thorough and presented very cool, like in a really cool way. So, well done.
Thank you very much. Just tell about yourself. You're 3 years in venture studio ecosystem, if I'm right. So how you?
Yeah, I moved to Nairobi 7 years ago, and I was a senior partner at a venture capital firm here called AHL Venture Partners, and in that role we invested in a ton of the leading startups across the continent, mostly in fintech, energy, and agriculture, but did fund investments and did some other things as well, and I loved it. But after a few years, I was getting a bit itchy and wanted to build again because I spent the first 13 years of my career as an entrepreneur. Basically, I looked at the startup ecosystem, and we mapped all the different startups in Africa against the various sectors. And there was a big black hole in the tourism sector. So tourism is the 3rd largest sector on the continent, but has virtually no startups that had been investable. And so I said, this is really interesting. There's thousands of startups in agriculture and all these different, fintech and all these different sectors, but virtually none in tourism. Why is that? The conclusion I came to was that, hey, there's no really good structural reason why there aren't more startups in tourism. There's a lot of problems in tourism that need to be solved. So, I started looking at that further. And around that time, I got introduced to the venture studio concept. And I thought, wow, this is a match made in heaven. An industry that has tons of different problems that need to be solved, a model that allows us to solve not just one of them, but solve multiple of those problems at the same time. Lo and behold, I went down this pathway with my co-founder to come up with the right plan and structure for Purple Elephant Ventures. We build startups at the intersection of tourism, tech, and climate, focused on the African market. We launched with the best timing you could ever imagine. We launched in January of 2020. COVID hit. Luckily it was just Jan and myself, my co-founder and I. We had a lot of, gut check moments to, if we were going to continue this or not, as the whole industry and the world had shut down. But, over time, we made the decision to stick with it because the opportunity on the other side was going to be that much bigger. Slowly, like basically 2020 was a write-off. Slowly 2021 was, things were starting to get back on their feet, but we were really starting from scratch sort of in mid 2021 when we started to gear this up again. We closed our financing round in the summer of last year, summer 2022. And so really we've been going at this, full steam for the last year or so. It's been great. Like, we're early at it, but the whole venture studio world is pretty early. We're learning a lot. We've built 3 wonderful startups. We have 3 other ones that we're building right now. And it's been a wonderful journey so far. And I'm absolutely in love with the venture studio model for a number of different reasons.
Can you tell more about your current portfolio? Like, what are these companies? You said 3 are building, and how many built already?
So we have 3 businesses that we've built that have co-founders. So our model is a relatively late stage venture studio. So we build startups. We internally at Purple Ventures study the problems in the industry. We come up with potential solutions to those problems. The solutions that don't work, we kill. The solutions that do work, we continue to work on, and we get them to a point where we're approaching product market fit. So we have a product in market, we have revenue. We're pretty confident we know what this business needs. And at that point, we bring in a co-founder to run the business, give them a significant piece of equity, and then we spin that business off. But we continue to act as an ongoing corporate co-founder in that business, continue to support them as they grow and scale. So we have 3 businesses now with co-founders in place, and we have 3 others that we are in the process of building pre co-founder. The 3 businesses that we've built include a business called Nomad Africa, which a little bit of it doesn't follow our story completely, but during the pandemic, we had an opportunity to acquire Kenya's leading travel publishing business. And so we did. And we completely transformed the business from a magazine publishing beautiful content about African travel to what we call a content to commerce business. So we're a publisher of beautiful content still, both like online and offline, but then we sell packages to our readers on the back of that content. So it's essentially a travel agency with content marketing powering top of the funnel acquisitions for the business. That's a very exciting business doing well. And the whole play there is to really truly understand where our customers are, what kind of content to serve them, what kind of content is going to lead to conversions into bookings, and optimize around that. And that business is doing quite well. We have a business called Kijani Supplies. So Kijani means green in Swahili. And this business is a supply chain business for the safari industry here in Kenya. So safari camps here in Kenya operate in pretty rough conditions in the middle of nowhere. And it's really hard for them to run. It's really hard to get, the things that they need to operate. If they run out of lemons, they often will have to drive, a truck 5 hours back to Nairobi to pick up lemons. And so it's a relatively simple business, but it's a very important business for this ecosystem, and that we're consolidating supply for the hospitality sector here. So we're building a one-stop shop for everything hotels and lodges need to run. And with a focus on green supplies, sustainable supplies, eco-friendly supplies, and with a carbon neutral distribution system. So running all through on electric vehicles. And that's a young business, but growing very quickly. The need for that business is tremendous. And then our third business that we're operating is called Elephant Bookings, although we're about to rename it. It is a SaaS play akin to Shopify for the African hospitality sector. So about 80% of bookings here in Africa go through travel agents, and the average travel agent commission is 30%. A lot of lodges are now wanting to sell directly to clients but don't really know how. And so there's a software platform that allows them to bypass intermediaries and go direct to consumer. Those are the three businesses that we have up and running, and then we have three other ones that we're working on. But I don't need to bore you with all of them. But we're having a lot of fun, needless to say.
You said that you attracted a round of investments 1 year ago. What is the amount you fundraised, and for what period of time?
We raised $1 million USD, and that will allow us to launch these three startups. We are in the process of closing an internal round right now. Investors are very happy, and so we're closing another little round with internal investors.
So actually, when you founded, you say that it was actually like the middle of 2021, because before this you were exploring the concept and waiting for.
Yeah, I think I was all in January of 2020, and then boom, COVID hit.
But when you hired the team?
Yeah, we started to build our team in mid 2021.
Can you share some, I don't know, figures of these three companies you have? Like, do they get revenue already?
Yeah, they all have revenue. They're all growing on a month-to-month basis. Our investors are all pretty happy with where they sit, and we're going to market to raise money right now for Nomad and for Kajani Supplies as well.
So is it like a seed round, something like this?
Exactly.
So your companies are based in Kenya?
Correct. Yeah, all of our companies are based here in Kenya to begin with, but we hope to expand them all relatively quickly into different geographies. Geographic diversity is quite important in the African market.
So I just want to imagine, like, probably salaries are very low in the country. So what is like runway must be much more than in case of, I don't know, the US or European venture studio.
Look, I take the approach that to optimize success, venture studios have to be A, sector focused, and B, run very lean in a very operationally very lean, in a lean manner, right? I was going to say leanly, but I'm not sure that's a word. Yeah, the idea for us is to build relatively inexpensively. Like, I don't want to spend more than $250,000 all in on a particular business to get it off the ground. If we can build a business and get it proven and get it raised for $250,000, I think that's will lead to a very, very strong IRRs for our investors.
And these businesses can have potential to become in 10 years unicorns or not? Or you think that it is sustainable, self-sustainable businesses which bring dividends, but the market size is not huge? What do you think about it?
I think, look, what we try to do is build businesses that have really strong positive unit economics and very strong big market opportunities, so that we can run businesses that can be profitable when we want them to be and can expand rapidly when we want them to expand, right? And I think especially in this day and age, building startups whose DNA is resilient but can grow quickly when market conditions are correct, critical to success in this market.
It's a bit more about like unit economics. So I just curious that like salaries, probably, I don't know, average salary is smaller, but I understand that you hire like really great specialists in your team. Like, what is runway, or what is your team is about 18 people, something like this, or not?
Well, it's interesting how big our team is. It's what's happened is that we hired a bunch of people to our Central Purple Elephant Venture team, and then as we've been building businesses, we attached many of our team members to those specific businesses. And now, as we're spinning those businesses off, many of those people are going to work for that business full time that they've been part of. And so we're actually at a very interesting inflection point now at Purple Elephant, where our core team is quite is quite small all of a sudden. We're still employing everybody, but through the companies that we've launched. But they've just, they've been very excited about the businesses. So a lot of them have ended up going to those businesses. In the process right now of rebuilding our studio team, there's no question salaries here are a bit lower than maybe in Europe or North America, which does give us the opportunity to have longer runway than we would with that same funding level elsewhere in the world.
It's very interesting, actually, for me. Like, what might be salaries, because average in Kenya might be $600. You even if you like raise,
so
if you're trying.
our salaries shortly, not now, but shortly will go anywhere from a few $100s a month to $8,000 or $10,000 a month.
Is there really great advantage that you can build a huge team with, I don't know, paying on average $1,000 a month and like creating a strong team which is able to launch new companies? So might be it's interesting for some, I don't know, potential venture studio founders to consider Africa, that it is very lean model to launch companies with huge market opportunity growing.
I think that's correct, but I think that's the same for any venture here, right? Like, so our pay scale is equivalent to other startups here. So there's no doubt money can go further in countries like Kenya than they can in, I don't know, the UK. I think that's the case for all startups. And one of the reasons why this part of the world has more and more and more startups popping up. On the other hand, there are there are definitely negatives about setting up shop here versus developed market, including quality of the abundance of high quality people is lower here. The ease of doing business is a lot worse in markets like this. Things tend to be a lot slower, more bureaucratic. And the local purchasing power here obviously is much lower than in other parts of the world too. So it depends on what kind of product you're building and where you're selling it. But there are definitely advantages to building here and disadvantages to building here as well.
How many languages are there in Africa? Do you do all in English only? Or how you will distribute?
Well, that's a good question. So in Africa, I think there's hundreds and hundreds of languages across the continent. Most countries have a national language that unfortunately is colonial. So Kenya's national language is English. Most of the continent is either English or French, Portuguese. I think that what we tend to do, we work in English, operate in English because we are in Kenya. But of course, our staff have to be able to operate in other local languages as well. That's why it's very important for us to bring in a diverse set of individuals to run our businesses from, different tribes here in Africa, different parts of the continent, maintaining diversity along gender lines and tribal lines and racial lines is very important for us, not just because it's the right thing to do, but it's also because it's the best way to build our businesses.
Can you elaborate on VC market? Like what do you expect for your startups that they will get like seed round of, I don't know, what is average there? Then like they get Series A probably plus rounds. Like can you just show like what is trajectory?
I think funding rounds here are very similar to funding rounds in the rest of the world. Similar dollar amount, similar equity valuations, maybe a little lower valuations here, but they tend to be equivalent to other parts of the world. So you do. Wow. Venture markets are all a little bit sideways, and they're sideways here too. But I think they're less sideways here than they are in Europe and North America. Economies here, we live in a global world, but we haven't seen the same, the same sort of financial markets distress here that we've seen in other parts of the world. It's still a little bit messed up right now, but it's not a total gong show.
When you fundraise, you usually rely only on African VC or Kenya VC, or to different countries. And
most of the money here is international money run by local local folks. So it's local investing in ventures. Well, in the venture world is small. It's growing, but investors here tend to be much more traditional and much more risk adverse. Most of the venture capital coming into Africa is coming from Europe or North America. Most of the funds are managed locally here. So they have a local office here, local staff who understand the ecosystem and who can engage, on a personal level with folks like me. But it really varies. Like, we have angels, we have North American angels on our cap table. We have local investors. We have a little bit of everything. And I think that's, in early stage markets like we're in, it's kind of the way it tends to be. The investment ecosystem here is not as developed as it is in other parts of the world. It's growing fast, but it's still, 10, 15 years behind the rest of the world.
If you say that valuations and all rounds are following European and North America benchmarks, I think it's really a huge gap between your low costs and valuations you can create. But probably to create this valuation, you have to reach also revenue, which is more difficult because you have to reach big audience. Probably, I don't know. But if you are focusing on tourism, probably you sell something to tourists who came from other countries. So like it is arbitrage, geographical arbitrage, or something like this here, right or not?
Yeah, you can look at it like that. I think that's not a bad way to look at it. I think one of the other big advantages that I might want to touch on here in this equation that's important right now here is that tourism is the world's best export industry, right? So tourism is actually an export industry where nothing gets exported and only the foreign currency moves in. And we're in a situation right now in Kenya where the government here is in a really difficult financial space. The Kenya shilling, the local currency here, has been devalued significantly in the last couple of years. And so the demand for US dollars here has never been higher. And, tourism is increasingly important in that respect here.
What do you think is important to talk about in the field of venture studios? Like, what do you think you do differently from others?
Well, I don't. You know better than I do, Max. I'm heads down working on my thing. I think just a few observations. One, I think it's really interesting, this terminology around venture studios or startup studios, and I getting a lot of basically accelerators are calling themselves venture studios these days. I think there's a lot of confusion around the term. And I think that, when I first started pitching investors about this, nobody had heard about a venture studio. Now some know what venture studios are, but I still think there's a lot of confusion in the marketplace around what actually is a venture studio and what's not. For me, a true venture studio is one that builds businesses from the ground up, owns 100% of them, and then brings in co-founders and, gets diluted from then on. But it really is, the building process is super important. It does kind of irk me when basically accelerators call themselves venture studios, because I think it dilutes the understanding a little bit around the concept.
If a team is involved like full-time and there are several people who are committed full-time, or at least like they have several ventures and their team is 10 to 20 people and they are spread between like 4 projects every year, something like this, I think they can call them a studio, even if they attract co-founders early on when they just start exploring what venture to launch. First, you do it internally until you maybe get to some point where you understand that, we get revenue, this business is working, so we are attracting founders.
And I think that's a key differentiator in what we do in this marketplace, particularly because there are no tourism tech businesses really in Africa. So if we went out to try to get people with ideas, we'd be sitting around bored all day. All right, so we have to create those ideas ourselves. I think also it's important in this market that we really lock in on an idea before we bring a co-founder in. And the types of co-founders we look for, therefore, are different than, we're not looking for a 22-year-old kid who's bright straight out of school with good ideas. We're looking more for people with a decade plus of experience, can bring real professional background and skills to the table, because we now know exactly what the skill set we need for this business is. And what's interesting, all three of our co-founders so far have been successful entrepreneurs in the past, but were looking for something, looking to start another business, but didn't want the terrible stress of doing it from the ground up, wanted a partner and from day one. So the model is also interesting. The conversations around structuring, we've chosen a holdco structure where we have a holding company that then owns our shares in each of the businesses that we've launched. We've avoided a GPLP structure. I think that's a very interesting question that needs to get ironed out, and industry standards in this space need to be established before institutional investors get really comfortable with investing in venture studios. And I'm a believer in the holdco model for venture studios, way more than I am the GPLP structure. But I think there's some interesting conversations around that as well. And then otherwise, it's just, we're heads down just executing on this stuff.
What is your usual equity split between you and your co-founders?
It's a negotiation. So we are not set on any particular number. What we do, for us, it's sort of a factor of a number of different parts of the equation. One is experience of the co-founders we bring in. Two is the type of business and its capital requirements moving forward. Therefore, how much dilution is going to occur in the foreseeable future. Three, it's about, speed of the development of the business. And ultimately, what it all comes down to is how do we optimize IRRs for our investors and for our co-founders? Our splits between us and co-founders vary significantly. I'm okay with that. I don't think there should be a take it or leave it offer to co-founders. I think it depends on a number of different factors at play.
So you have both, like somewhere you have a majority of equity, somewhere do you have some ventures where you have lower equity than a founder?
No, we don't have any that we have lower equity than a founder. Now that could change as these businesses grow, and happy to continue to reward founders with increased equity as these businesses grow. But I think, especially because we're building later stage businesses we bring in co-founders at a later stage where we put a lot more effort in these businesses than some venture studios, we want to retain more equity.
It will be interesting to know, will you be able to fundraise other startups in Africa? Because I know that some studios, they also do a lot of work before onboarding a co-founder. And it is an ability for them to convince great entrepreneurs who already had, previous exits or successful entrepreneurship experience. So you choose between like equity and a professional founder. Like what is
I think you can do both. Like I think you can bring on the we've brought on very high level professional co-founders and got to a position on equity with them that they're happy with and we're happy with, and I think incoming investors will be happy with. I think if you build really strong businesses, everybody wins, right? So I'm less obsessed about this equity conversation than some. I think that the first thing is let's just go out and make a fair deal, and let's work together to build awesome businesses. And I know there's a lot of talk about investors. Not some investors are not comfortable with studios who have a significant portion of the cap table. Look, and I think that's fair for studios that are really hands off on their businesses. But we don't intend to be debt equity on the cap table. We intend to continue to really work with and support our businesses. We see ourselves as an ongoing institutional co-founder for these businesses. We'll continue to support them, continue to help them grow, and I think we'll earn every ounce of equity that we have on the cap table, right? And I think so. So that's an important, I think, piece in the way that we're set up from day one. Not to just leave our companies to flounder. We're there to support them on forever.
Because you do them with positive unit economics, it means that they are not so dependent on investments, probably. So, like, even in the worst case,
I think that's fair. I think that we want to build resilient businesses that can manage downturns. I think especially in the African market where there's more risk in a lot of different ways, especially in African tourism, you have to build businesses that are flexible and can absorb body blows, but that can grow quickly when times are right.
One more question about the model. So you mentioned that like we plan to invest 250K into a startup. This means that you cover all expenses for salaries of your team to launch this company until it gets external finance round, right?
Correct.
You don't invest money on the balance sheet. You don't send it. You just cover all expenses until it can attract, right?
It's a good question. So what we're doing currently, and this could change, but I'm not sure it's the 100% best solution. But what we're doing right now is we are funding the business until we get a co-founder in place, and then once that co-founder comes in place, we then give them a certain amount of money to basically based on budgets and stuff, we give them a budgets to run. Anything that they need to spend above that number, we then provide it for them, but we write it because it's a separate entity. We're transferring money between an entity like Purple Elephant Ventures and then an entity that we don't own 100% of anymore because the co-founder is there. We then we write that as debt. So when the business raises money, that debt gets repaid to Purple Elephant Ventures. But typically, it's not a huge amount of money.
I'm always thinking about figures because it's easier to understand the model. What do you average? I don't know, revenue when you're on board. So you said that you're always on board when there is already revenue. So what is like, I don't know, 5K a month or something like this?
Yeah, we've gone everything from like in our three businesses have been very different. So, we've gone from one has $100,000 of revenue a month. One has $4,000 of revenue a month. So it's big differences.
Those who have more revenues, they already feel themselves like more sustainable and independent from investments. Do you have some playbook or some model, or it is like case-by-case scenario for developing companies? Maybe you have some understanding that we use first 3 months to get the first customer or something like this, or build the product.
Exactly. That's exactly what we have. So we break it down into 5 different stages, and at every stage we have different gates that we run a business idea through. So the first stage is ideation, where we come up with all the great ideas, and we have different criteria to look at those ideas, and then we push certain businesses into research phase, where our research team spends 1 month looking at these businesses, basically doing desk research, getting the business to the point where a really good idea deck, like what really well thought through, defensible deck that a pre-revenue investor would look at and be impressed with. The best of those ideas, we move to what we call early validation, where we are building MVPs to test out the leap of faith assumptions that underlie the business. And so each of those businesses, depending on the type of business, the approach tends to be a bit different. But at the end of the day, our approach there is to hone in on the leap of faith assumptions around the business and try to prove or disprove them. And then once they're proven, then we move it into late stage validation, where we, actually start, ramping up sales a little bit. And at the same time, we bring in a co-founder at that point. And if the business succeeds we start the process of bringing in a co-founder and finding them. And then by the time the business is finished late stage validation, we've got a co-founder lined up, and then we put the co-founder in the business. And then the last stage, then we two sort of stages that are kind of one. We spin the business off. So we get the co-founder in, we onboard them, we help them raise money, and then they're independent entities. But then the last stage that we continue to support at is the scale up stage. So we help continue to work with them in various different ways as they scale up their operations. And it's not always perfect, but we try to keep to timelines and try to keep to ultimately we want to create a conveyor belt manufacturing process for the development of successful startups.
During your experience of managing a venture builder, can you share some mistakes you did that you understand, or this is not true way to do it?
Yeah, I think we made more mistakes than I care to admit, Max. But that's part of the fun of building a venture studio, right? And especially in this part of the world, we're building without a playbook, right? It's not like there's a set playbook yet for venture studios. It's not, especially in Africa, especially in tourism. So, look, we made a lot of mistakes along the way. I think one of the a number of different observations. So one is around team. So initially we built a team brought on too many operational generalists and not enough specific, people with specific skill sets that they could lend themselves across multiple businesses. So I'm now a believer in at the studio level having a team of true specialists in different areas that can lend really unique insight into our entire portfolio, and then hiring operational people into each business specifically, and not asking operational people to bounce between different ventures.
Does it mean that every person you invite and enroll in the team, they have to have experience in tourism?
No, it does not. It does not. Exactly the opposite in some ways, because we have product developers that don't need to know anything about upfront about tourism, climate people that don't need to know a ton about tourism, or UX UI people that don't need to know a ton about tourism, or financial people that don't need to know they'll learn tourism, but I really want them to bring expertise from other parts of the business world to the table. Some of the operational people need to know tourism, but I'm a believer in getting as many voices from as many different industries and PEV as possible.
Can you explain again what differentiates a generalist and a person you hire exactly for some specific business? Like what are you looking for? Can you explain again?
A product manager can do product management work across multiple startups. If they're really good, they can be a leader, they can build a team around them, versus a general ops person who just can, really dive in and do one specific aspect of running one business really, really well. The ops type people we reserve we now put into specific businesses from day one, and the people with real subject area specialties we put at the venture studio level, working across all of our startups. So that was a big learning. There was one business in particular that we held on to for too long before we killed it, and we just have to be endlessly ruthless about killing businesses that we might love but are showing really bad initial results. So I think there's a number of different lessons in that regard that we could share.
You mentioned that Purple Elephant Ventures acquired Nomad magazine, turned it into a new company. So I have just known that you launched a big Canadian media company. Can you just elaborate on this? Like, how it helped you to to relaunch this business in Africa? Because I
Well,
saw that it's
yeah,
quite
for
big
like
non-profit organization.
yeah, for the first 13 years of my career, I was in media. So I founded an NGO called Journalists for Human Rights, or JHR, that works across the world, mostly in post-conflict zones, helping rebuild local news media communities after they're destroyed by civil war. I also, after that, I launched a digital news startup called Newsana that had a bunch of different properties, but was basically in the business of news aggregation and curation. Yeah, like certainly, like my experience in that industry lent itself well to repositioning Nomad. Although, look, I'm a believer that unfortunately, the content industry is no longer about content from a business perspective. It's about how do you monetize that content through forms other than advertising, because advertising based business models are dying a rapid death at the moment, right? And so the real trick is innovating around other revenue sources for content, and that's what we're trying to do with Nomad, right? Is we've taken a traditional type of content and combined it with a traditional business model, another traditional business model, agency model, but together, where those two businesses intersect, magic can happen. And so that's what but yeah, certainly all my experiences in different ways have helped me help lend themselves to this venture studio that I'm running now. And I think being an investor is, I think with both my entrepreneurial experience and my investor experience are critical to the venture to building a venture studio, because you're building businesses, so you have to know how to operate, but you're also building a portfolio. And so you need to understand how to build a diverse set of investments within a portfolio. And so I think both of those skill sets are critical at to build a successful studio.
One more small question is about companies you closed. So on your website there are 5 companies. Can you also elaborate on how much time did it take you to understand? So you said that there was one example that it was too long.
Yeah,
But
so the too long one was a business called Wavel Travel, which was all about remote work. So the idea was that the tourism industry is not set up for remote workers. So especially in Africa, you don't know if the place has good Wi-Fi. It certainly doesn't have a really good, home office, probably, where you can actually take video calls and not be disturbed, right? The idea was that we would build a business where we would take long-term leases on properties, turn them into remote working, ideal setups for remote working, and then rent them. Sort of like a Sonder or Oyo, specifically for remote working. And I loved the idea. I still think there's something there, but we just couldn't get the business model right. And so after many attempts, we decided to kill the business. And I think we pivoted a few different times trying to figure out the right business model to solve the problem. We just sort of gave up on it. But I think we should have given up on it a lot earlier. I think, I guess we were in love with the problem and never fell in love with the solution, but oftentimes falling in love with the problem leads you to try multiple solutions when there really isn't one that's appropriate. Yeah, so that was a heartbreaker. But then other ones we killed relatively quickly. There was one on there, I think, about, just as an example, a distressed debt fund for the hospitality sector here. That was one we looked at in COVID, and for a few minutes it looked like it was a good idea, but relatively quickly, I think we did about 50 customer interviews, quickly discovered the tourism industry here is it's not particularly levered up. So there wasn't a lot of need for distressed debt. And if there was an appetite, it would be at well below market rates. And so it just didn't make sense from a business model. So we put a bit of time into it, did 50 customer interviews, sketched some stuff out, but we weren't actually operating anything with that business before we decided to move on. So.
do you have some calculation, like, for example, you launched 3 companies successful, at least at this point, then you have 5 companies which closed, but how much money you put into launching every company? I mean about your future projections, for example, 250K already includes this unsuccessful
Yeah, so we don't
attempt.
put a lot of money. No, we don't put a lot of money into these into these businesses before we kill them, right? So it's staff time, and we haven't broken out staff time specifically for each of the businesses we've killed. I suppose we could do that exercise, but I think that's all part of baked into the 250 for each successful business we launch, right? It's part of that staff time to get to a place where we have a successful idea.
And also, can you cover a topic of raising into studio, fundraising? Like, was it hard for you in
Yes.
2021?
Yes,
So
it was
just
very
describe
hard.
it.
It was very hard because of a few factors. The first factor was venture studios. So very hard to raise money for venture studios. No, very few investors are comfortable with the model. You end up in pitch meetings. I found I myself sucked into endless conversations about the structure of our venture studio as investors try to understand it, as opposed to actually like talking about what we actually do. And so, and a lot of hard conversations. And also funds typically don't have the, like closed-end funds don't have it structured where they can, or the mandate to invest into venture studios. There were a lot of hard conversations, and then around the structure and, aligning our structure with the investment criteria and mandate of the investors we were talking to. And then the other challenge was just tourism. African funds, like most parts of the world, most African funds have very strict sector mandates, and tourism, because for a variety of reasons, but one of those reasons being that there is very little investment in tourism to begin with, tends not to be on the investment mandate of most funds, and so, or most investors' radar screens. And so, we had success with investors that we talked to that had the freedom and flexibility to invest in us, but 99% of the conversations were a quick no. This doesn't fit our mandate, and then an hour of me explaining what a venture studio is to them because they were interested in it. And so, yeah, it took a while. We had many hundreds of funding conversations before we were able to close. But basically, all our investors were people that I and my co-founder knew personally, had invested in us or with us previously, and had those deep relationships with before. And I hope that changes. Like, I do hope now that the venture studio world is bigger, that funding gets easier for raising for studios. But based on all the research I've seen, it's really hard for people without pre-existing networks to raise for a studio.
Thank you, Ben. I love your story because for me it seems that you chose very interesting industry, which is really like export for people who can go into Africa, and you use quite lean model. You had previous experience, both like venture and your industry, like creating a media company. So I think that it is a very smart approach to launch this venture studio.
Thank you.
COVID, of course, it was not right time for you, but maybe it's better that you didn't raise money before.
Well, it gave us time. It gave us time, right? It gave us time to slowly do this and learn it all and gather our thoughts. But yeah, I still would have preferred that COVID didn't happen. So.
Okay.